and I'm joined by Mike Miller, Chief Investment Officer for Crucial Partners. Mike, if you want to just wave your hand so folks know who you are.
Sorry, guys. Hi,
No,
everyone.
that's great.
Hello, good morning, good afternoon.
And Lawrence Miller, who leads our Vermont investment pool.
Good morning.
We also have joining us Tim Briglin, who is chair of our investment committee, and Barry Pius, who is our VP of finance. You just want to wave your hands so folks know who you are. That'd be great. Thanks for being with us this morning. These public investment calls are held for current and prospective fund holders at the foundation to offer a quarterly performance and market update on our three investment pools, the long-term, mid-term, and socially responsible pools, which Mike will provide us an update on. And then also our Vermont investment portfolio, which Lawrence is here to join for that. He'll provide an overview and some highlights on the pool, including some of the projects that we've invested in, whether those are community development projects, venture funds like Fresh Tracks or Flex Fund, or some of the equity investments that we've made. As some of you may know, 5% of every fund at the Vermont Community Foundation, whether it's a donor advised fund or a nonprofit fund, is actively invested in the Vermont pool. The Vermont investments is something that we hold very dear at the VCF because it can have an outsized impact to any one fund, and it is alongside the grant making that we do. Since 2002, we have been setting aside 5% of assets into the Vermont pool, and right now about $20 million in investments are made annually. So with that, I'm going to turn it over to Mike, who's going to offer us a Q3 performance update. Mike, over to you.
Great. Thank you, Stacy. I'm going to share my screen with everybody, if that's okay. Except that all of a sudden
you have the controls, Mike, I think.
I do. And then, no, it's funny. Excuse me, guys. It was right here in front of my screen and now it just disappeared. Hang on one second. I'm so sorry.
That's okay. While you're doing that, I'll just say we will let Mike run through his presentation, and then we'll take some Q&A at the end, and then we'll turn it over to Lawrence, and then we'll have some more time at the end for additional questions. But if there's anything that's top of mind that you don't want to wait to ask, just put it in the chat, and we'll be monitoring that as well.
Yep. Okay. I'm almost there, guys. I'm so sorry. It was funny. I did the test. Oh, here it comes. Whew, made me nervous there. Okay. Let me just make this bigger so you can all see it better. So one more second. You can see my screen though, correct, everyone?
Yes.
Yes.
Good. So I'll start off by saying that one of the principles that you've heard about before from us is that we don't believe we can, or anybody can, forecast what markets will do in the short term. In the long term, actually, there's some interesting signs you can use to help guide you, but short term you can't. And so when we get into extremely complicated times, which is the best way to describe where we were before the election and where we still are after the election in the United States a couple weeks ago, it's complicated. And it's an interesting dichotomy to think about when you're at the Vermont Community Foundation is responsible for a pool of largely, but not exclusively, perpetual assets. At the end of the day, short-term volatility is very uncomfortable for everybody, very unpleasant and very important. But long-term inability to preserve purchasing power is actually even more important. And so this is very uncomfortable balance that exists where you're faced with potentially, I'll talk to this today, more risks than we've seen in a long time when it comes to how to invest capital, both good and bad risks, mostly bad. And then the second thing, there's such a thing as good risk, believe it or not. And the second thing I'd say related to that is that volatility, we used to have a slide years ago, and it'll probably come back, unfortunately, where we'll say volatility is our friend. And volatility is the friend of a long-term investor, only because people do react in a very sometimes emotional way to it. Not everybody, of course, does, but and it's interesting, and it creates opportunities. So before we dive into all that, here are the returns for the long-term pool, the socially responsible pool, and the midterm pool over a bunch of different time periods. The story really hasn't changed very much, which, if you recall, the long-term pool is a more diversified pool. It's a more actively managed pool. And you can see it's struggling, especially over the last 3 years, to keep up with its benchmarks. That's partially its private equity investments, just kind of trudging along. And it's also its absence of enough Magnificent Seven exposure, which I think we've talked about many times. And I'll hit that one more time, but I won't continue to talk about that all the time, I promise. And that 3-year numbers kind of drag down even our 5 and 10-year numbers. So we're below the benchmarks there too. I'm going to give you another perspective on that as I've done before later. I will come back to it. The good news is what you can't see in these numbers is the long-term pool has begun to significantly and consistently outperform since really July. And we're seeing something very different in the markets right now, which is helpful. And it's not just that small cap stocks or value stocks doing well. It's actually that you don't need to actually own the Magnificent Seven to do well right now, which is really important. And long-term pool has had some, particularly one or two extremely positive outcomes that are still ongoing and generating more and more profits. So we have a lot to look forward to there, in our opinion, from in terms of how that part of the foundation's assets behave. The socially responsible pool has been a much more pleasant place to be, in part because it's got a much larger, index exposure in it. So you can see it's tracking the indexes more closely. And that has really been, you can see, beneficial from an absolute and a relative return perspective. Only 15 years is it just slightly behind long-term pool, which I think gets to an interesting point, which is that you can invest in a lot of different ways and get to, pretty significant outcomes and good outcomes. The midterm pool, which we'll go through in a second, as a reminder, is a more conservatively managed pool. It's got more bonds in it, essentially, which is why the returns are lower than the other two pools. That was what we would have expected in a market like this one. The midterm pool also happens to use quite a bit of index fund management as well. So, as you think about these things, those are the different options that currently exist. So I'll jump ahead because one of the things I mentioned how we think about the long term. Just for a second, I'll go back. So you see these numbers across the top of the page. If you look at the long-term pool exclusively, for the year, obviously, who doesn't like a 19% return, although a 21% return would have been better, of course. But what's interesting about the returns from 5 years out to the March of 2000 numbers, is that what's interesting about that is those numbers all look equivalent, essentially, like 2002, excuse me. They all look equivalent, like, 7.8, 7.6, 6.7, 7.2, what's the difference? And the difference is that when you start to think about compounding, which is what this chart does. So all this does is take the exact same, or it's just the long-term pool in this case, and compounds them. Like, so what was the cumulative return, not the per year return, which is what I showed you before. And by the way, all the returns you're seeing in this entire presentation are net of investment management fees. So there's no additional investment management fees being applied. So if you look to the left, you see that what looked like fantastic 1 year, which it was in an absolute sense, 19% return. But as you go to the right, you can see that it doesn't really seem that important anymore when you think about things like 10-year periods, 15-year periods, and since 2002, which is when we started working for the foundation. And clearly what you'll say is, and I would say, gosh, earning only 7.7% per year for the last 3 years versus 13.5, that's not a good outcome. We agree. But then as you get over across the page, we started to say, okay, yeah, but this was all done in the interest of the same strategy that produced the 15-year and the 20-plus-year performance, where particularly since 2002, there's been a massive premium to the benchmark, which is what I'll show you in a second, how to think about this another way. But right now, at this moment in time, it's very fair to say, gosh, the last 10 years have been a nice, decent return, but we would have been better off in the index. Can't say that for 15 years, and you certainly can't say that for 22 years. And I'll walk you through a little bit later why we think the next even 3 to 5 years are going to be quite a bit different in this regard. And we're pretty excited about what the foundation is doing, what the investment committee has authorized, and ultimately the board as well to capitalize on just the market conditions we have today. So this is the right way, forgive me for being so judgmental, to look at performance, which is to not assume that when we sit here today, we're looking at some kind of the final word on the subject. That's both the good thing and bad thing. If you're a football fan, in investing, there's no spiking the ball in the end zone after you score a touchdown and you win the game. It doesn't work that way. It's a continuous process of trying to invest. And when you're doing badly, maybe you put a little bit of mediocre outcomes. You put some faith in, well, we know what we're doing. It'll come back. When you're doing really well, you don't get to do a victory lap either. So it's kind of cuts both ways. So what this table is showing you is the performance of the pool. This is the socially responsible pool, not just on September 30th, but on literally every single month end back to June of 2010 when it was restructured into its current form. And then just basically looks at every single 3-year period, 5-year period, 7-year period, 10-year period. So think about if we had all had the pleasure of spending, maybe not even Zoom, but had coffee in person and maybe a pastry or two every single month end for the last 14 years, or give or take, what would we have seen on those reports, essentially, is what it's basically this is trying to say if we added them up. So that's the batting average, which is what percentage of the time did the socially responsible pool outperform its index. And you can see 66. So if we sat down every month again over the last 14 years, really 11 years, because it's a 3-year period, 2 out of 3 times we would have seen the portfolio outperforming. If we looked at the 10-year numbers, every time we had a 10-year numbers, 9 out of 10 times we would have seen the portfolio outperforming. Then what you see underneath that is how much did the portfolio outperform? Because by the way, if the portfolio outperformed 80% of the time, hypothetically, and added literally 0.5% over the index, you and me would both agree that, well, why did we bother? We basically paid fees to a whole bunch of people and we got barely what the index got, and we didn't even beat it all the time. So why would we do that? But what this is showing you, if you look across the page, now these are not per year, these are cumulative, but for 10 years, the pool has actually outperformed the median. And the median is the middle of distribution. So half the time was better than this, half the time was worse than this. But the average, essentially, if you want to use that term, was 6.4%. And that's a significant amount of capital in your funds and other funds that are supporting Vermont. And so it's worth it, is the point that we're making here. And we see the long-term pool, you'll see it's even more worth it. Then we also look at best and worst case outcomes.
What's invested in Vermont?
Yeah.
Yeah, sorry.
I think there's somebody who needs to be on mute, if you don't mind checking your mute button.
Oh.
And I can also try to answer that question too, real quick. That was a good question. Socially responsible and long-term are every pool in the foundation was, as Stacy noted this far, I want to emphasize it too. Everything is invested in Vermont, has at least the 5% exposure, has the 5% exposure to Vermont that Stacy referred to earlier. So this applies to all the pools, just to be clear. The best and worst case outcomes you can see are essentially, what was the good days like, what were the good days like, the very good days, and the worst days like. And other than 3 years, we kind of like, especially 7 and 10 years, to see that when things are good, they're much better than when they're bad. And I think that's a really important component of how we make sure, hopefully, we maintain your confidence in what we're doing. Now, the social responsible is a little bit easier because it's more heavily passive. Let's go to the long-term pool, which is much more complicated recently, because I showed you it's underperforming for 10 years. So jump to the top right number here. You see the 92.1%. So what that tells you is that this is a relatively rare thing that we're doing right now, which is underperforming for 10 years. 92% of the time, the portfolio is outperformed. And you can see it's actually outperformed almost 80% of the time for 3 and 5 years and 7 years, and 92%. So it's actually, when you talk about if you were a baseball player or a baseball fan, gosh, who wouldn't want these batting averages? Unfortunately, though, in the investment world, and as it should be, we all look at these numbers and say, well, is it good or bad? And we look at that moment. We don't think about the averages, which is why we show these averages. So again, relatively rare to see the portfolio underperforming like this. And then you get back to that earlier comment about, was it worth it? Look at the second line under 10 years. So essentially the median outcome was 30 percentage points above the index. Now, yes, that's not true today. I think that's really important. That was not the last 10 years. But if you look at every single 10-year period, again, we're not leaving anything out, back to 2002 in this case, 30% was the median, which is a massive amount of added value. And then, of course, much to my pleasure, and I hope yours too, the best and worst case outcomes were remarkably asymmetric, i.e. 39% was the very best we did, and -4 was the absolute worst we did. So -4, just to be clear, is -0.4% per year, basically. So really, really important as we think and how the investment committee thinks about the strategy, which is, does this strategy actually work over time? And the answer is, in our way of thinking, clearly yes. Is it working exactly at this moment the way we'd like it to? No. Although I do feel like next time I see you, it feels like it's gonna be a little bit better. We'll see. So next slide. One of the key things that you don't hear from me, I'll talk today about interest rates and risk and all these things, but I want to make really clear the strategy is built on these long-term outcomes. We are actually willing to give up some short-term performance as long as we're confident we're going to get the long-term outcomes we need. So there is something very much to that. And there are 3 basic rules we follow. Rule 1 is we think long-term. That's what the first point is meant to say. Rule 2, I referred to this earlier. We don't think we know where markets are going in the short term. We don't try. If you think about a lot of the information, I think that most of us are at least asked to consume. It's very short term. Like, what's the S&P going to do for the next 6 months? I get asked that question all the time, and I really, really, really don't like it because I have no idea. And so usually I try not to be, kind of snarky with anybody, but I want to say to them, as much as I know about that, because we don't know. Do we know that we own a portfolio of undervalued investments that are worth dramatically more than the current price? Yeah, we know that. Do we know what will happen next 6 months? No. So very, very important. The opportunistic point, I'm going to come back to that a little bit later when we come to the market conditions right now, because this is an unusually interesting time to be an opportunistic investor. We'll talk about that in a minute. And last but not least, this is a thing that's been lost in the current world. Diversification still works. I know everybody thinks I just want to own the 7 or 10 stocks because they've been the best, and that absolutely has been the right thing to do. But it's not always the right thing to do. And when it's not the right thing to do, if you're too concentrated, you're taking on way too much risk. And people don't always quite align with that thinking. But I'll try to walk you through why we say that in a minute as well. So here are the mixes of the 3 pools. I won't spend a lot of time in something to say that you can see that the socially responsible pool and the long-term pool are both very heavily public equity oriented. The long-term pool and the socially responsible have private assets. The hedge funds are on the way out, just to be clear, they won't be here for long. And then we have relatively modest levels of bond exposure. And bonds are getting more interesting as we speak, as interest rates rise. If they stay low, they're not as interesting. The midterm pool is the definition of balance, as you can see, 47.5%, 47.5%, and then there's the Vermont investment piece that I referred to, or Stacy referred to earlier. So I'll jump in. Oh, last thing. This is reviewed no less than annually by the investment committee. It's not always changed because you go back to the philosophy. This is a long-term strategy. For example, back in earlier 2024, we all were thinking about the election for sure, but none of us made any investment decisions based on it because, again, we don't necessarily know the outcome. And as I mentioned earlier, we certainly don't know what the markets will do, and that's a critical element of how we do this. I'm going to jump by this really quickly. The portfolio, both portfolios long-term have outperformed their benchmarks net of fees. I'm not going to spend a lot of time on this, but this is basically about a little bit about the due diligence process behind managers. One of the critical things is Vermont Community Foundation has, in my opinion, is some of the greatest investors in the world. And these investors, it also uses index funds, as you heard before. And the balance is the critical element. And when you have access to the great investors of the world, you will win in the end because they have tremendous advantages over other investors, particularly around just their patience. So there are 4 rules we follow. Again, I won't spend a lot of time on this. I'm going to say that there's no such thing as a risk-free return of any significance, at least. Second, from our perspective, the committee puts this trust in us to do this work. We have to know the strategy, we have to know the key people, and we have to avoid needless complexity. So we're very focused on who has not just the great track records, but who has, as the bottom point says, the best prospective returns. Usually, of course, they're somewhat correlated. Of course, we don't just take we don't gamble on people who've never succeeded before suddenly becoming good at their jobs. So I'll keep going. I'm going to jump through. There's a lot of things if you were a crucial analyst you would be looking at, and this is a small level list of them. The investment committee gets frequently 12 to 15 page reports on any manager when we're thinking about making a change or adding a manager or subtracting a manager, and all of these things and others are covered in that kind of assessment. So let's jump to the world we live in today, because I want to make sure there's lots of time for questions and to get to Lawrence. So I think it's interesting. Sometimes I feel like the moment we live in is the moment we think about for good reason. That's a good thing for meditation, I suppose. But at the same time, I think we have sometimes hard time assessing where we are in the great pendulum of history in terms of, is this the riskiest time ever? Where does it fit on the continuum of risk? And we don't know the answer to that question. I don't think we can objectively answer it either. But we can say one thing, which is as long-term investors, this is a really risky time. And I think we're basing that statement on 4 things. One, as many of you know, inflation is back. Is it going to be hyperinflation and completely destructive inflation? No. Is it going to hurt? Yeah. And is it just going to go away like nothing ever happened? No. There's too many structural geopolitical issues that are going to essentially put a floor, in our opinion, under inflation. And if you have higher inflation, you have exactly what we've seen in the last few years, which is you have the need for higher interest rates. You have the need for central banks to act differently than they have before. And that creates what we call a higher cost of capital. You guys see that in your savings accounts, I assume, where you're getting paid more, which is great because when you have a higher cost for capital, you get paid more as a saver and investor. And you also have to look at that second word or third or fourth, whatever it is, competition. So now you have competition for capital. And it's a really interesting thought because when you look at a T-bill and say, well, I can get 4.5% and take almost no risk, hypothetically, maybe I don't need to own as much in the S&P 500. You may or may not come to that conclusion, but it's at least an interesting conversation to have with yourself. When interest rates are 0.5%, the conversation is less interesting if you think about it. So that's what competition for capital means. And if you create competition for capital, then what you naturally do is you create capital scarcity because then, as all of you and us and everyone else who invests capital, we're not being forced out on the risk curve anymore. We can take low risk and get a decent return. And that creates scarcity, i.e. the absence of capital or more expensive capital for anybody who needs to borrow money or raise money. And the riskier a company is, the riskier situation is, capital scarcity can be a death knell for them because they want be able to access capital at a good rate. And so this is a massive shift. I'm going to show you why in a minute, but this is a massive shift in the investment climate that people don't pay much attention to, I realize, because it's kind of one of those, we call them pernicious risks, which are things people don't think about enough, but it's really out there and it's really set into the situation today. Geopolitical instability, that we actually added that after 2 weeks ago, because I think there's just so many things that could change here, whether it be US policies, whether it be trade, tariffs, and you can pick on so many different things to go for there, regardless of what your political persuasion is. But there's a lot of things that are changing, that's for sure. And I think actually both sides of the aisle would agree on that. And then the fourth thing is that in spite of all these risks, investors had an interesting reaction to them, which is one reaction would have been just go to cash. You've seen people panic in market periods of great risk for markets. The second thing they've done, which they've done today, is they've just kind of said, nope, I'm just going to own the companies that I feel safest in, and I'm not going to worry about the risk as much, which is an interesting choice. I'd call it an odd choice, but we'll show you that also in 1 minute. So here is a little bit of a picture of some of these complexity issues. So one thing I did not mention, which I want to mention now, is the top, you can see the unemployment rate compared to the size of the widest budget deficits over the last 40 years or so. And what's interesting is the middle column is the unemployment rate at the time. The budget deficit as percentage of size of the US economy is the far right. And you can see, at currently, and the current I think was around 930s to be clear, the budget deficit running 6.7%, negative 6.7% essentially, which is pretty high by historic standards, and tests, of course, we continue as the United States tries to continue to test the limits, if there are limits on what the US can borrow. And we'll find out if hopefully we'll never find out what that limit is, because that would be bad. But what's unusual, you can see, is that this is a time where even though you could argue about whether the unemployment rate is reflecting the actual unemployment in the country, the reality is that it's still not super high. I think most of us would agree on that. And it's interesting that you'd have such high budget deficits with such low unemployment. And this is part of where we get back to the capital scarcity question, which is that the Federal Reserve, in addition to all of its other problems today, and investors in general, will have to continue to buy these bonds, essentially, that the US government's issuing, perennially, perpetually, it feels like. And the deficits don't seem like they're getting smaller going forward. There are theories that it could, but the reality is the most likely path forward is larger and larger budget deficits, which again, back to capital scarcity, if you make capital somewhat more scarce, and the US government's borrowing more and more and more money, well, then you create more and more pressure in the system, which gets to the chart at the bottom. So this is the Federal Reserve's balance sheet. So if you look to the left, prior to 2009, the Federal Reserve, if we drew this chart further to the left, it was just a straight line for the most part at the bottom. That little bump you see to the left is the beginning of what was at the time a new strategy for the Fed, which was to do something called quantitative easing. And what they did is essentially created money, because they can do that legitimately out of nowhere, and just use it to buy government bonds at the time. And that's that bump up you see. And it created a lot of concern that it was going to lead to inflation, it was going to lead to all kinds of problems. And as is case, usually the experts got it wrong. It didn't lead to anything other than it didn't really help that much either, but it did certainly maybe stave off a financial crisis back at the time. The problem was it was supposed to be a short-term emergency measure, and you can see what happened, which is it actually never quite got to the short-term part of it. So that as that line goes all the way up and to the right, where you see it jump up again, kind of 2/3, 3/4 of the way across the page, that's COVID. Where was another jump up, and then after COVID, it kept going up as the economy struggled, and the Fed decided this was their greatest idea ever. Now look at the right, though, where the curve turns down a little bit. That's what they're calling right now tapering. And what's happening is the Federal Reserve is not buying bonds after they mature. So a mature bond matures that they owned, they don't repurchase the bond, and their balance sheet gets smaller and smaller and smaller. But as you can see, it's still over almost $7 trillion balance sheet right now. And our point is that this is also one of the factors driving capital scarcity. And in fact, this, if you think about it, with one very important caveat to come, is sort of what started the 2022 meltdown in the stock market. Because once you start again, the market was starting to appreciate capital scarcity, appreciate higher interest rates, appreciate inflation. And then a very convenient thing came along for those of you who are big S&P 500 bulls, which is people decided AI was the coolest thing was ever going to happen. And they started throwing their money back into the market, which is why we have the AI boom of today, which is interesting. But this is still happening in the background, and it's not insignificant. I'm jumping ahead quickly. So here are the top 10 weights in the S&P 500 as a percentage of the index. This is very important, because what this is showing you is that the index is more concentrated than ever. And the way to think about this is, so the way an index weight works like this one, the size of a company determines its weight in the index. So if, for example, Apple, which is a $3.5 trillion company, it becomes a bigger and bigger weight as went from 1 trillion to 2 trillion to 3 trillion in size as the company goes. And the 35.7 you see to the right essentially is very important because that shows you that this is a very unusual, going back to 1990, level of popularity for the top 10 names in the index. And here's the thing. We could debate all day.
I can't do it yet. She's not even doing
Sorry.
any work.
Sorry, someone might need to mute. But so what I would just say quickly, sorry about that, is that the concentration you can say a lot of things that we could debate whether Apple deserves this price from NVIDIA or anything else, but what we can't debate is whether or not concentration and risk are synonyms, and they are. So what we did around the four corners is we listed some of the risks to these businesses because it was kind of interesting when you think about the Magnificent Seven of that group, which is Apple, Amazon, NVIDIA, Tesla, Alphabet, Microsoft, and I'm forgetting somebody, Meta. What's interesting about these businesses, they do have some common risk factors, which is challenging for everybody to think about the risk on top of the risk on top of the risk. So one is some of them are monopolies, which is a risk because government can come in and break them up, or at least make it harder for them to continue to grow. They actually, as a group, have more dependence on China than most people realize. Lots of revenue, lots of profits, lots of production happening in China, some in Taiwan as well. And so if you think about geopolitical risk over there, you're taking on a lot of that in the Magnificent Seven today. And I don't think the markets don't care at all about that, but if they ever do, watch out. AI, I know we use the word hype because I'm sorry, now I'm going to say it. It is hype. A lot of what's happening in AI is really interesting and exciting, and a lot of us may be even using the tools. And we know a lot of great investors and great venture capitalists who are investing in this area and can explain to us and have explained to us how exciting this is. But some of these stocks are just out of control how popular they've become. People don't really fully understand what they're buying, and they don't fully understand the risks they're taking. So there's a lot of hype right now going on. And then last but not least, in a related point, all these stocks are subject to a lot of optimism, which gets us to this piece here, which is this is the top 10 names. Again, here they are. So for those of you who don't know, it's Apple, NVIDIA, Microsoft, Amazon, moving from the left, Google, which is Alphabet, Meta, Berkshire Hathaway, forgetting the name, AVGO is another AI company, chip company, Eli Lilly, JP Morgan. And what you're seeing here is the blue bars reflect their weight in the index. So that's interesting. So Microsoft, NVIDIA, and Apple are all $3.5 trillion companies or more, which is just a massive thing. The entire US economy, I believe, is about $14 trillion in size. And so it's just really interesting to think about how big these companies have become. Maybe it's not 14, it's bigger than that, but it's not that much bigger. But what you can see here is the blue bars should reflect the size of these companies. The red bars reflect how much they actually earn today. So what you need to think about is, this is not a perfect analogy, but when, for example, Apple is a 7% weight in the index and 4.8% earnings contribution, what the market's basically saying to you is that Apple is going to earn so much more money down the road that it will justify this size. And that's why we keep saying it's a lot of optimism. And it doesn't apply to all these names. You can see, if that's why you can't talk about the Magnificent Seven as a universal thing. Like Alphabet, Google, actually the numbers are the opposite. Meta is about normal or about the same. But Microsoft, NVIDIA, which is particularly interesting, and Apple are all trading at very, very rich valuations to what they actually earn. So again, that might be fair, but the problem is it requires that they do a lot of growing. And how fast can trillion-dollar businesses grow is an interesting question to consider. Now, right now they're growing quickly, but if that were to end, watch out. And this is one of the last things I want to spend some time on today, if you don't mind, which is that a lot of people today will say, rightfully so, why do I want to own a value stock ever? Shouldn't I just own growth stocks? Aren't these better companies? I want to be in the tech world. I want to benefit from the changes going on in technology and growth, et cetera, which is, again, it's a perfectly valid point. It's also an incomplete point. And so I want to walk you through some things that we have to think about at the Community Foundation that are very important. And I think you should think about them too. So this graph that you're looking at shows you how Frank Russell is an index provider, how the value index they have and the growth index they have kind of compared to each other over time. So when the line is dropping, that means that the growth index is outperforming the value index. When it starts to rise, which they've shaded in gray on this graph, that means value is outperforming growth, and so on and so forth. And you can see it's very cyclical, i.e. it's actually not as definitive as people might think today. Now, the reason people feel the way they do today, though, look at the base of the right-hand side of the graph where it turns white, the shading goes away around 2006. It's been without with a very short exception in 2022, this has been a remarkable period of growth outperformance. Now, it was preceded by a remarkable period of value outperformance, which people forget, but this has been some cycle. I mean, it's literally like, you forget 2022 for a second, we're talking about 17 years here. I mean, isn't that long term? And it is. But here's the thing that we have to think about the Community Foundation, which is, again, if there's no goalpost, and no touchdown in the end zone, then what if this were to change? What happens if it changes? And we have to think about that. And the reason it's such a painful potential process is three other things I need you to focus on. Look in the middle. You'll see that actually the idea that growth stocks are so much better than value stocks is actually untrue. If you go back to 1979, they're basically about the same return. And keep in mind, this is after a massive growth cycle. So 12.2 versus 11.5. By the way, if you really have a 50-year time horizon, give or take, then you're right. You can own either one, no problem. But now look at the circled areas. Look at the top circle first, which is what happened. What did these indexes generate when growth stocks did well? That's what the top right is. So it says you see the 5.38 and the 29.42 and the 14.78. What that's saying to you, forget the 5.3, it's not important. The 29.4% is what the growth indices returned per year when they were the dominant index. At the same time, the value indexes did 14.8% per year. And here's the thing that I think about a lot, and maybe I should think about it less, but if someone said to me, hey, you're going to make 14.8% on your stock investments for the next, 5 years, wouldn't you be happy? And I'm like, yeah, I think I'd be really happy. But not if then you say to them, yeah, but you could have had 29.4, then you're not as happy, right? That's just the way we all are wired. And none of us are exception to that. So that wasn't a judgment of any kind. But now look at the bottom. So what happens when the value indices outperform? They get about the same return, 13.8%. In fact, you'd rather own value stocks and growth indexes are outperforming if you think about it. But look what the growth indexes did. 0.6% per year. And this is the critical point, which is growth investing, while sometimes very much in vogue, is not always in vogue. And when it's not in vogue, it's a massive disaster, usually, for those who are worried about earning CPI plus spending over time. The Vermont Community Foundation cannot take its equity portfolio and wake up 10 years from now and say, oh, we earned 0.6% per year on that, especially when we could have earned 13.8. I can't think of anything more disastrous. I don't love showing you guys 2.5% per year for the last 3 years versus 4 point whatever it was. But that's not a death sentence. What we're talking about here is a death sentence. And I think this is really important. And this is why we think about staying balanced, why we think about making sure we realize that things change and the controversies, changes, all kinds of things happen in this world. And these facts actually are not just history, they're also logical too, which is people get too excited about a good thing. That's what you saw in that Apple chart before with the big blue bar and the red bar that's smaller, and they get too pessimistic too, which is the thing we try to take advantage of. So last but not least, the foundation has a simple strategy here. We rely on things with a high probability of success. That's why we don't guess where the markets are going. We're actually not guessing when the cycle of growth and value is going to change. We have no idea, but we're not going to abandon our highest returning investments just because they're not as popular as other investments are. Foundation has an amazing hundreds of millions of dollars that we can use to access some incredible investors. In fact, I'm looking forward to maybe a quarter or two from now telling you a really interesting story about one of the investments that it's really not public information yet, but it's a really exciting investment in the portfolio now. And it's one of those things that comes from being in an organization like this when others can't really access stuff like that. And then last but not least, and this is the part that we think about with regard to elections, et cetera, is that we have to intelligently accept volatility because that gets us higher returns. So I'm going to stop sharing, I think, because I feel like I may have taken up too much time, Stacy. I'm sorry.
No, it's great. It's all such an important insight. Thank you, Mike. Let's just take a minute to see if there are any burning questions that folks want to put on the table before we turn it over to Lawrence. Anybody out there? Okay. Do put it in the chat. I'm not seeing anybody come off mute. So do put a question in the chat if it comes up. Otherwise, we'll come back to Q&A at the end. Lawrence, I'm going to turn it over to you.
Terrific. Thank you. I will share my screen and walk you through this conversation. The Vermont portfolio is obviously a little bit different from the large pools. We have a different set of objectives here, serving the same mission. but where Mike is seeking to produce financial returns that support our grant making, the mission investment portfolio is out in the community working, and our goal is to make sure that we retain purchasing power net of losses, expenses, and inflation. And we do that by investing in a variety of tools in Vermont, a lot in intermediaries, funds like Features, Flexible Capital Fund, Fresh Tracks, of course. And we also have programs that do some direct investing and lending to nonprofits and other organizations and some businesses. We are overseen by a Vermont portfolio committee that is separate from the investment committee, chaired by John Vogel, who's on the call with us today, and members that include a couple of people on the call with us today, Charlie Kirker and Mark Foley are here as well. And I got a lot of support from Jeff Smith on the accounting team. We basically work in alignment with our opportunity gap impact areas where our grant making focuses. That includes affordable housing. And I will say that our definition of affordable housing is expanding these days. It is no longer simply low to moderate income, right? We have a workforce housing challenges throughout Vermont as well, and finding ways to participate effectively. Some of that participation isn't just financial. We don't have a lot of cash in this fund, but how we can participate in unique ways that help advance projects is what we focus on. I'll talk a little bit more about that as we go on. Entrepreneurship, particularly in rural areas where a business might be a anchor part of a small community, even with a small number of employees. You know, a small 50-person company makes a huge difference in rural Vermont. Downtown revitalization, food and farm, and clean and healthy ecosystems are the range of areas. We're talking about two pieces. We've got the Vermont pool, which originated with the 5% allocation and a 5% of all new gifts. And then we've got some non-pool assets as well, with those things that have been given to VCF over time that we perpetually reinvest in Vermont. You'll note that these values are 731. One of the things about the Vermont portfolio is it's all pretty illiquid stuff. We invest and then we hold it for a long time and it doesn't get a lot of revaluation. We revisit it periodically, but I don't ask Jeff to jump through making new charts for a non-material difference between 731 and 930. So these are the charts I used for the last portfolio committee meeting. And so you see it's grown meaningfully over time. The internal returns last time I checked are something like a 2.6% return. So that long-term goal of preserving capital net of expenses and inflation over that period of time is being met. This growth here is a combination of a little bit of return and new funding being added to the portfolio. We are and looking at that as well and saying, hey, we've got people who are interested in more participation in the Vermont pool and more participation in the Vermont portfolio. So we have taken a step back and really thought about ways that we can make that happen. We've developed a social impact charitable fund tool that allows for an increased allocation to the Vermont pool. This is suitable for larger DAF holders. We don't think you should have more than 20% of your funds with VCF in something like this, and administratively complex. Less than $100,000 doesn't really make a lot of sense, but it gives us a way for some people to look at participating. Of course, when it's in this, given the illiquid nature of the Vermont portfolio, it's not available for grant making. So it's worked sort of by making a refundable, recoverable grant to your social impact charitable fund, and then it gives you a way to get that money back into your DAF at the end of the investment cycle. And we've got a couple of examples. The VCF at Hula Fund is a sidecar at Hula that they provided for us so that they help manage that money and access some deals that are coming through there. That's a direct investment example. But we've also got the opportunity for people to take an increased position in the Vermont pool and sponsor an investment. So you get the Vermont pool returns, but we put a little bit more money into one of the investments that we're already managing. So the Flexible Capital Fund is raising money for Food, Farm, and Forest, their Fund 2. We've got Features, which is focused on medtech. We've got the Northern Forest Fund. And so this is a way that we're looking at to be able to slowly provide a little bit of increased exposure for those people who are interested in that kind of activity. Now, I mentioned the way we try and work together in alignment between the impact areas of grant making and what we're doing in mission investing. And I thought I'd lift up one community as an example. Plainfield has been really hard hit. You know, they were going through the decline of Goddard, which was been an anchor institution there and closing. You know, a variety of rural economic challenges that are typical, fragile anchor institutions locally. And then they got walloped by the floods, just walloped. 37 housing units and 27 buildings gone, right? If the full buyout program goes through that's been recommended, that'll be 8% of the grand list disappearing. So this turns out to be a good example of how we can approach community with integrated capital. I was over there a few months ago helping the co-op buy the Plainfield hardware store. Plainfield hardware they were retiring, thinking about whether they would go out of business or sell the business. Plainfield Co-op was in a small space beyond not really fitting what they needed. So they were going to go ahead and buy it. They had a lot of pledges from community members to support it, but they couldn't quite bridge to that. And then the flood happened and they couldn't finish their fundraising. So we lent them unsecured money against, you know, those future pledges and some future fundraising so they could complete the transaction on time, get into the new space and keep moving. That community connection has been really helpful. I helped me understand what the community needs were. So when somebody brought me just a couple of weeks ago an opportunity for an infill project in Plainfield, we were ready to act pretty quickly. This is a really remarkable story of a group of community leaders who identified this critical need with all of that housing wiped out. He said, hey, people stepped forward, so we've got this property. We'd be prepared to sell it to the town so at what we got into it so that the town can subdivide it, redevelop it, and then sell the lots to others. And so this will provide for 30 or so 1/8-acre housing units, some multifamily. It's all within a 1/4 mile, right? This is walking distance. So this is a village extension. These folks took a look at this and they moved so quickly. It's really impressive. This community is gathered around this project. They got the wetland delineation done before the weather turned, and they're moving. So I was looking at them for a loan to help support the first phase of engineering. Well, the town really is in a position to take on even an unsecured loan right now. They've got a tremendous amount of financial pressure. So this is my ability to turn to our colleagues in grant making, and they could make a grant towards the engineering firm. So they'll be able to have a full package prepared for this project by the time town meeting comes around. And we'll continue to engage and figure out if there's ways that we'll support it with an investment as they go through the infrastructure phase. One of the things we see very frequently is that the initial infrastructure costs for some of these projects that can't be absorbed until all of the units are sold make them nearly impossible. And it's very difficult to fund with bank debt. And very difficult to fund with municipal debt when a municipality is stretched like this. We can provide the type of patient capital where we come in early and we come out late and charge very low interest rate that just helps us against inflation. So that's the type of project that we're seeing more and more of as our potential role in housing and experimenting with that. We have a lot of other things on the plate. I would say I wind up getting in a lot of conversations that don't wind up leading to an investment that we make. But I figure we're successful if in those conversations we can help those people achieve the outcomes they're trying to achieve, whether they need our money or not. And so when you are supporting VCF in these activities, you're supporting a group of people, our board, our committee, and our staff being out in the community, identifying opportunities like this and helping these local organizations and local people do things that they otherwise wouldn't be able to do. And we're really grateful for your support.
Thanks so much, Lawrence. There's a question in the chat, a couple questions in the chat from John about the threshold, the 20% threshold or $100,000 threshold, and whether we want to expand that, you know, to give other folks access at a lower price point, so to speak. And then the second question was about the recoverable loans, and can you say that the pool is return capital?
Yeah, so we are, I would say this is an experimentation phase. You know, we started with the VCF at Hula. We are have fulfilled a couple of interested transactions with Working Fields, with Northern Forest, and with commitments to the Flexible Capital Fund. I would say when we figure out how to streamline this process, we'll be able to look at lower amounts of participation. But I think until we really, you know, get this exercised, we'll have to be cautious. Want to make sure that we're going to be able to serve everybody effectively. And so that's walk before we run is my approach.
Great.
And
Lawrence, can you
we
speak to the loans? Yep.
Yeah, and when we do that, for example, if we've got it a social impact charitable fund supporting a specific investment, we'll match the term of that fund to the duration of the investment. So if it's aligned with, say, for example, a 7-year note in the Northern Forest Fund's activities, the social impact charitable fund itself will have a 7-year term, and then we'll redeem it at the end of that 7 years.
Thanks, Lawrence, so much. You know, the mission investments can feel a little bit abstract until we start talking about them in specific terms. So I hope that Lawrence's overview of Plainfield gives you a sense of its tangibility and its real world impacts in each of our communities, and how that can go alongside the grant making that fund holders are doing, or in the case of a nonprofit organization, its own individual impact in community. So we think of these things as sort of stacked capital, if you will, and the net impact over time between both the market investments that Mike's team leads for us, as well as these local ones. We have about 10 minutes left, and I'd love to lift up some questions or curiosities about either Mike's presentation or Lawrence's. So invite folks to come off mute or put questions in the chat. This is not a shy group, so inviting you to speak up. I know there are great questions out there about some of these projects. In the market, the state of the market is not quiet.
Can you hear me, Stacy?
I sure can. Is that
Okay.
John?
I was just going to say the one other thing about the mission investing that I think is critical is that it allows us to work with for-profits as well as nonprofits.
Mm-hmm.
And not all the good that happens in Vermont happens with nonprofits.
Yes, that's a great point, John. That's a great point. And Lawrence, I don't know if you want to speak to that a little bit in terms of some of the development, the equity investments or the investments in entrepreneurship.
Yes, and it's interesting because one of the things that some of us worked on a number of years ago was the original development of the L3C, the form of limited liability company that was originally expected to be paired with a IRS deductibility for investment, and that never happened. But we've got these purpose-driven organizations that are organized as for-profit companies in Vermont. And, Front Porch Forum comes to mind. They're not a borrower investee of ours, but they're a very prominent organization around Vermont that's doing a lot of good, and that you would think this has got to be a nonprofit, but no, it's not. It's organized as a for-profit company. Working Fields, we and several of our DAF holders are invested in. They're providing services, wraparound services to people seeking employment, and they do it through a temporary employment model, right? But they're providing these wraparound services to clients who are coming out of substance use disorder, they're coming out of rehabilitation, they're coming out of incarceration and re-entering society, or they're new Americans and need some extra support services. And so this is another example. It's a for-profit company with a nonprofit-like mission. And so it's really neat to be able to do those. And then there's others that are more conventional businesses. They might not be organized with a purpose focus in that sense, but they might be an intrinsic part of their community, but have access to capital issues, temporary or long-term, for some of what they're doing. And we can play a role often in bridge financing. We do a lot of work in our Food, Farm, and Forest Fund, Taproot, where we work with farmers, obviously all organized for-profit. Rarely does that come true, but we can be super flexible and come in with things like emergency feed loans, right? Things like flood response loans. We can do it on a low documentation way, do it on a basis of character, and be able to move really quickly. Sometimes we can do that through our grant programs. In the case of the floods, the Secretary of Agriculture declared the entire farming community that was affected by flooding as a charitable class. So we could actually move grants towards those farms. Usually we can't do that. So by doing it with flexible loan instruments or flexible investment instruments of other kinds, we can get in there and do something that as a foundation, we can't provide personal benefit to people, but by being able to be more flexible than their bank could be in the moment, that allows us to support people whose missions are making a difference in our communities as for-profit entities.
Thank you, Lawrence. Thanks, John, for that great question. There's one in the chat from Rob. Just please describe the special opportunities that make up 14% of the long-term pool mix. That's to Mike.
Yeah. Hey, so that's essentially more concentrated strategies, things that are very heavily focused. And so they're equity investments, to be clear, they're public equity investments, but they can be more concentrated. So we have a firm that's actually an activist investor in Japan, for example, that's based in Japan. That fits in that bucket. So they're very specialized niche strategies. And the investment committee carved them off years ago, one, to make sure that when we introduce them, get paid to own them, and two, to make sure we don't end up with too many of them, even though the committee obviously control that in a variety of ways. So they're basically public equity strategies that are a bit atypical, and we use them because they have much higher return expectations than other investments we make. And two, they diversify the assets quite a bit, which is really useful because it's more about what one or two or three companies do than is what the markets do per se at times that can affect the returns.
Terrific. Thanks, Mike. Thanks for the question, Rob. Okay, we are 5 minutes from the end of our call. Just wanting to do a soft nudge for any other questions for Lawrence or Mike, or for the VCF team. There's quite a few of us on here today, so let us know what's on your mind. Okay. All right, hearing none, I want to thank everybody for joining us today. Lawrence and Mike, appreciate you so much and all that you do for VCF and for your partnership and leadership. And thanks to everybody on this call for your investment through the Vermont Community Foundation, and invite you to join us at the next public investment call, which will be after the turn of the new year. Wishing everybody a great holiday season. Thank you.